Hello everyone, this is Arnaud Delapierre. Today we are looking at a key moment in financial history, the famous maneuver by George Soros on the pound sterling that earned him, hold on, 1 billion in a single night. In this video, we will dissect the economic context of the time, the strategies implemented, and the consequences of this operation for the Western monetary system. The goal is to provide you with a sincere and concrete insight into this story. Stay with me until the end. Not only is it very informative, but it can also feed your thoughts on current financial markets. To fully understand the issue, let's go back a bit. Let's go back a little. In the early 1990s, Europe at that time operated with a monetary mechanism aimed at stabilizing exchange rates. The pound sterling was then pegged to a minimum rate, but the context was not favorable to the British economy. High interest rates were weighing on growth, and the Bank of England was striving to defend the parity of the pound against the German mark at all costs. In this tense atmosphere, George Soros, already known in the financial world, sensed an exceptional opportunity to challenge the Bank of England. To make money by betting on a decline, one usually engages in short selling, more or less short in jargon. Specifically, the goal is to borrow pound sterling, sell them betting on a drop in the price, then buy them back when the price is lower. Thus, the difference between the selling price and the repurchase price is pocketed. Soros was convinced that the Bank of England would not be able to support the pound if there was massive selling pressure. He then positioned himself negatively in a very determined way, energized by his own analyses and favorable timing for his bet. Before continuing with the rest of the story, let's take a moment to talk about Notrade, a mobile application available on iOS and Android, completely free. It allows access to trading alerts on stocks and crypto. Its interface is designed to be clear and efficient, so to have very high quality trading signals processed by artificial intelligence. Real-time notifications help to follow the markets without being glued to a screen, which is perfect for those who want to keep an eye on their investments while maintaining their usual lifestyle. Try it out without hesitation, since it's free if you're curious. Let's get back to our story. The Bank of England, on its part, tried to curb speculation by drastically raising its interest rates and using its reserves to buy back pounds. This policy aimed to maintain confidence in the currency, but it ended up further weakening the British economy. Companies found themselves strangled by expensive credit, while volatility kept climbing. Meanwhile, Soros and other investors believed that the pressure on the pound was going to divert the Bank of England from its initial objective. The markets were ruthless, and the rates tightened on the English currency. On September 16, 1992, the day now nicknamed Black Wednesday marked a decisive turning point. The Bank of England initially tried to appear strong by raising its main interest rate, but failed to stem the selling wave. Investors saw it mostly as a sign of panic, not a true guarantee of stability. At the end of the afternoon, the authorities eventually announced that the pound was exiting the European exchange rate mechanism. This move created an immediate shock in the markets, and it was precisely at this moment that Soros realized his colossal gain of about $1 billion. Soros' strategy relied on considerable capital, of course, and significant leverage as well. He had borrowed enormous amounts of British pounds to sell them on the market at the peak, with the idea of buying them back at a lower price. When the Bank of England gave up, the value of the pound plummeted, allowing Soros to repay his loan by spending much less than at the time of the sale. Initial balance. The difference entered his account, and that's how the workforce resulted in this monumental profit that left a lasting impression in finance. The exit of the pound from the exchange mechanism caused a significant drop in its value. In the short term, this perhaps seemed catastrophic for the British, who saw their purchasing power reduced, for all they were in the process of bringing. Nevertheless, economists emphasize that this devaluation subsequently boosted the country's exports by making them more competitive on the international stage. At the time, panic prevailed, and the popularity of John Major's government suffered considerably. The reputation of the Bank of England also took a hit in the eyes of financial observers. Morally, this operation raised many questions. Some believe Soros merely exploited an unstable situation, considering himself that the pound was overvalued. Others think he worsened the crisis through his speculation, precipitating the devaluation of the currency. Whatever one may say, the episode demonstrated the power of such market movements and reminded that even a central bank is not infallible. Soros, on his part, defended his actions by stating that he was merely pointing to an economic reality while taking advantage of the opportunities provided by a fragile system. For traders, this episode is often cited as a textbook case. It highlights the importance of building a strong conviction, knowing when to commit and when to withdraw. Risk management is also crucial. Soros didn't gamble blindly. He surrounded himself with analysts and prepared his plan based on concrete figures. As for central banks, they have learned that it is better to avoid prolonged standoffs with the markets when imbalances are glaring. Communication and responsiveness of financial institutions have evolved since this crisis to limit such scenarios, of course. Soros' success is not the result of mere random speculation. He applied a precise methodology based on fundamental analysis, understanding of cycles, and constant observation of monetary policies. This involves work, diligent monitoring, and the ability to act quickly when the situation arises. Markets often reflect the mindset of millions of actors, which can become explosive. Without a structured plan and an appreciation of risk, one can be swept away by volatility. Conversely, having clear reasoning and unbreakable patience can make the difference during financial storms. Soros's meteoric success on Black Wednesday thrust him into the spotlight. The international media then dubbed him the man who brought the Bank of England to its knees. Imagine the headline, incredible for a trader. This notoriety had varied repercussions. On one side, many have hailed him as a model financial strategist. On the other, he is sometimes portrayed as a speculator who takes advantage of economic weaknesses, or even a conspirator with hidden ambitions, as I found on some forums. Subsequently, Soros also chose to donate part of his fortune to charities and foundations supporting education and freedom of expression. The impact of this stunt was felt long after '92. Many fund managers saw this operation as a signal that it was possible to challenge seemingly unshakable institutions. This may have encouraged other speculators to test the resilience of states deemed vulnerable. Governments have therefore sought to strengthen their systems or to soften certain mechanisms in order to avoid a spiral, unavoidable, uncontrollable. This story mainly shows that a determined individual or group can influence currencies, especially when the fundamentals don't follow. Markets rarely thrive in uncertainty, and the slightest flaw can trigger reactions. Sudden, the psychology in this success cannot be ignored. Soros is known for his frankly decisive stances and a lot of composure, even when the markets are turbulent. He has a habit of questioning his own convictions and analyzing risks bluntly. This clarity helped him act with firmness. Timing is a crucial factor. If he had anticipated the fall of the pound too early or too late, the outcome might have been different. This example shows how a prepared mindset combined with a thoughtful strategy can lead to results that defy predictions. To conclude, let's remember that the example of George Soros and Black Wednesday demonstrates that sharp reasoning, meticulous preparation, and a certain boldness can produce immense effects in the stock market. His success transformed the perception of the power of central banks and opened the eyes of an entire generation of investors. I hope this story pleased you and gave you a better view of what can happen when economic elements come together. Don't hesitate to subscribe, activate the bell, and like if you enjoy this format. See you very soon.